Mortgage rates are finally showing signs of relief after the Fed's latest rate cut. But for many home buyers, affordability remains a serious challenge. Right now, the average 30-year mortgage sits at just over 6.3%, the lowest we've seen in almost a year. But even with the lower rates, home prices are still a big hurdle, up about 50% nationwide since the start of this decade. And inflation remains stubborn, running above the Fed's 2% target, which is why the rates may not fall as far and as fast as buyers hope. All right, let's get some insight with Dr. Alex Su, Associate Professor of Finance at Georgia Tech's College of Business. Thanks for being on the show. All right, the rates are easing, but we still have high prices and stubborn inflation. Is now really the right time to buy?
Well, so the Fed cutting rates now will help some. So typically long-term yields, which the mortgage rates are tied to, will do fall when the Fed cuts the Fed funds rate. And lower yields means lower borrowing rates for home builders to borrow money and build homes. We'll have a fairly severe housing shortage in the U.S., anywhere from $2 to $5 million, depending on the estimates you're looking at, in terms of single-family homes. And on the demand side, obviously lower interest rates will allow borrowers to borrow at a cheaper rate, and that should increase demand.
So why don't the mortgage rates drop as quickly as the Fed lowers its benchmark rate?
Yeah, so I mean, that's a complicated question, but obviously, interest rates is a price, right? So we know that price is determined based on supply and demand. So if mortgage demand spikes because people think now might be a good time to get in, it will increase applications and then potentially can increase the rates slightly. Of course, as you mentioned earlier at the beginning of the segment, inflation is always the big concern. The Fed target inflation is about 2%. We're nowhere near that. We're actually closer to 3% right now than 2%. So, if we see inflation rise further in the next 6 months, potentially the Fed would have to stop the rate cuts after 2025.
For people who aren't into numbers and economics, they really just want to know one thing: how much am I paying monthly? So for first-time buyers here in Atlanta, how much of a difference does a half percentage point or even a full percentage point in the rates make on a monthly payment?
A very big difference. I don't have the calculator in front of me to do the math, but a 1% decrease in rates could cut your monthly borrowing costs by probably 30–40%. So it's a big deal. And we're at the beginning of a potentially rate cutting cycle. So the first cut is 25 basis point. The expectation is they're going to cut 2 more times in 2025. But whether or not the cutting will continue in 2026 is way to be seen.
Now, we know Atlanta's housing market has been one of the hottest in the country for years now. What do you think about the lower rates risk of sparking another surge in competition here? It got pretty wild at one point. You think that will come back around?
That's another, again, everything comes down to supply and demand. And the lower rates will increase, obviously, buyer interest, both for potential home buyers as well as investors, right? Lower rates, easier to borrow money, and people tend to want to put that money to work, and real estate is one of the kind of potential assets people like to invest in. So lower rates can lead to more demand for housing, which might lead to increase in home prices. But that's hard to say at this point because there's so much uncertainty in the macro environment with policy, both fiscal policy and monetary policy, that we'll kind of have to wait and see at least through 2025 to see how things go.
All right. Dr. Alex Su, thank you for being here with us and bringing us all that great insight.